This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hi everyone, welcome back to the channel. On January 14, 2026, Evolve launched INTY, the fourth addition to their UltraYield series. Following in the footsteps of BGI, CANY, and SCHD, this new ETF primarily targets markets outside of North America. The timing of INTY's launch isn't accidental. It comes on the heels of international markets broadly outperforming the US over the past year. It seems every investor is now hunting for growth opportunities beyond the American border. So today, let's talk about INTY and Evolve's UltraYield series. First, let's talk about the setup. INTY follows the same blueprint as its three predecessors. It employs a 50% covered call coverage ratio coupled with 33% cash leverage. In terms of distributions, INTY pays out twice a month at 26 cents per share. Based on its $25 launch price, we're looking at a staggering projected annualized yield of approximately 25%. However, we need to address the hidden costs. While the management fee is 0.6%, keep in mind that this figure does not include transaction costs or the borrowing costs required to maintain that 33% leverage. Even with Canada's relatively low interest rates in 2026, these interest expenses still represent a structural drag on the fund's actual performance. Since the fund is brand new, our focus today will be on deconstructing its underlying holdings to see if they can actually carry this weight. INTY's core portfolio is highly concentrated, holding just 10 global industry giants. We can break these down into 5 key sectors. First, the semiconductor titans. ASML controls the lithography source, and TSM controls global advanced fabrication. These represent the deepest moats in the current tech cycle. Second, healthcare. This sector provides powerful countercyclical properties, serving as the steady floor that allows the 33% levered portfolio to function during market stress. Third, Japanese industrials and tech. Toyota enters 2026 with massive profits from its hybrid dominance, while Sony contributes stable returns through its dual engines of content and sensors. Fourth, energy hedge. As an energy titan, Shell provides a necessary hedge against inflation and geopolitical risks. Fifth, volatility and growth drivers. While Alibaba represents a value recovery play, Spotify is a crucial addition. Although Spotify pays zero dividends, its high growth and extreme volatility generate the massive option premiums required to fuel INTY's 25% projected yield. When choosing a high-yield ETF, you cannot simply look at the headline yield, because a covered call strategy effectively sells off the upside potential. The only way to sustain the NAV while harvesting dividends is if the portfolio's organic annual growth can match that yield. In my view, achieving a 24% organic annual growth rate for this specific portfolio is a very tall order. If you look at these 10 stocks as a whole, they resemble a global blue-chip balance group rather than a high-growth group. Expecting every giant in this mix, including old-school industrial names like Toyota and Shell, to explode like tech stocks in their prime is simply unrealistic. Let's look at the true colors of these holdings for 2026. TSM and ASML are the standout performers. Analysts expect TSM's revenue to grow by 23% to 25% in 2026. ASML had a strong January due to 2 nanometers orders, but official full-year revenue growth guidance is only between 6% and 10%. Novo Nordisk's profit growth is indeed expected to exceed 20%. The remaining 70% of the portfolio consists of low-growth traditional giants. Markets currently expect Toyota's 2026 net profit to potentially drop by 26%, with revenue growth estimated at a measly 2.8%. Shell's projected stock price appreciation is only around 10%, and the analyst consensus for Novartis is a dismal minus 0.7%. Alibaba has a 20% plus recovery potential, but geopolitical volatility often makes its performance a one-step forward, 2 steps back affair. Backtesting this portfolio on Testfolio reveals an average annualized return of just 19.31% in 7.81-year history. While INTY utilizes 33% leverage, that leverage is largely consumed by offsetting the volatility lost to the covered call strategy. I believe INTY's performance will track closely with its underlying holdings. This means the holdings themselves can hardly have enough runway to cover the 25% payout based on his historical data, which inevitably leads to NAV erosion, which means a declining stock price. The situation for the other UltraYield ETFs is slightly different. CANY doesn't actually face this specific issue, as its historical underlying stocks growth has generally been sufficient to support their payouts. SCHD does show a slight lag where growth struggles to keep pace with distributions, but it is not severe. However, we must note that even with a strong portfolio, the risk remains. Over the last 4.7 years, the underlying portfolio of BIGI suffered a maximum drawdown of 60.51%. With 33% leverage stacked on top, if a similar extreme event occurs in the future, I hate to imagine the NAV approaching zero. I highly doubt the dividend levels could be sustained in such a scenario. I have always maintained a conservative stance on Evolve's UltraYield series. The fundamental flaw here is the abandonment of index-based selection. I'm not sure if this shift was forced by market competition, as fund managers are increasingly using high-concentration portfolios to juice the yield. In my opinion, moving from a broad market index to concentrated stock picking turns the essence of an ETF into a high-stakes gamble on individual names. In a traditional index ETF, if one or two companies fail, the other 400-plus names hedge the loss. In INTY, each stock represents about 10% of the weight. If just one of these 10 giants falls into chronic structural distress, that 33% leverage will instantly magnify the loss to an unacceptable degree. Take BIGI as an example. Its holdings in Coinbase and MicroStrategy have dragged the entire portfolio's return to 0% due to the downturn in crypto assets. Ultimately, the wealth management market has entered a bizarre yield arms race. Fund companies are aggressively adding leverage, increasing concentration, and essentially cannibalizing the principal just to market a flashy headline number. Historically, a 10% to 12% payout was the gold standard for high yield. But nowadays, it feels like funds are embarrassed to even show up unless they're touting 20%. Personally, I'm not in the business of predicting the market. All I can do is look at historical data, run the numbers, and try to strike a balance between potential returns and the risks we're taking on. My advice remains the same. Don't let a 25% headline yield cloud your judgment. When we pursue passive income and build a cash flow portfolio, the most critical consideration should be how far the engine can actually take you, not how fast the car looks when it's rolling down a hill with the gas pedal floored. If you enjoyed this content, please like, subscribe, and leave a comment. I am Old Fish, and I will see you in the next one.